Once again, my name is Caesar, founder of Tax Advisory and Financial. In today's topic, we're going to discuss the differences between the standard deduction and the itemized deduction. Okay, and those differences will be for both federal and state level. First, we're going to go over the federal differences between the standard and the itemized deduction. So for 2026, the standard deduction for a single taxpayer will be 16,100. 16,100. So if the personal expenses for a single taxpayer are below 16,100, okay, that taxpayer will be better off by claiming the standard deduction. Let's say this individual's personal itemized deductions are 14,000, then his itemized deductions will be lower than what the government already gives them. So he'll be better off by just taking the standard deduction under the federal. However, the state, we're in California, for instance, California gives a 5,800 for 2026 standard deduction for that particular single taxpayer. Okay. However, if this taxpayer has 14,000 in expenses, itemized deductions, then of course he will need to itemize under the state to take advantage of a bigger deductions. Okay, that's the first thing between the main difference between the itemized and the single. The same thing applies for a married couple. Okay, married couples standard deduction for 2026 will be 36,200. Okay, again, if the married couple's deductions is below the 36,200, this couple will be better off by taking the standard deduction. So it's only when the personal itemized deductions exceed the standard deduction given by the government in a given year. Okay, and the standard deduction for someone who is a head of household, either that person claiming a child, okay, or that person claiming one of the parents. Okay, those are qualifying relatives for this person, for this taxpayer to be entitled to be as the head of household. That head of household for 2026 will be entitled for a deduction of 24,150. Okay, so those are the standard deductions for every single filing status. Okay, so what are the qualified expenses that go against the standard deduction? Well, first we have the medical expenses. Medical expenses will be accounted for as an itemized deduction. Okay, and also we have the SALT, which stands for state and local tax. So any income tax paid, okay, any income tax paid to your state, okay, from your wages or in advance as estimated tax payments, those will be accounted for as itemized deduction, income tax. Also, property taxes. Okay, so high state taxes. Most likely, those taxpayers will be getting a bigger benefit, okay, than those taxpayers who are in a state where they don't pay any state tax. Okay, so that's a big one, the state and local tax. And for 2026, we have a cap of 40,000. So if you paid any income tax and property tax, okay, and if those taxes exceed, or you could take an advantage of up to 40,000, and that will be accounted for as in addition to the itemized deduction. Okay, and then on top of that, we're going to also include the mortgage interest. Okay, on any of the mortgages. If assuming it's a main residence or even a secondary residence. Okay, for personal use. Okay. In addition, we have donations. Okay, taxpayers are entitled to claim donations. Okay, to any it needs to be a nonprofit or it needs to be a charitable contribution. Okay, yeah, donations given to family members or donations given to destitute individuals. They're not qualified donations and they will not be accounted for as part of your itemized deductions. Okay, uh, so those are basically the deductions under the federal law. However, we still have state deductions which account in addition to those federal deductions, and we have deductions such as union dues. Prior to 2018, we were entitled to claim those expenses, and they were accounted for as itemized deductions. Okay, since 2020, since 2018 and on, those the state deductions that I'm gonna cover in a few minutes, those are not qualified deductions under the current state law, under the current tax laws. So donations will be a qualified expense. Okay, uniforms and clothing will be an additional. Okay, your cell phone expense if you use it for work, that will be also an additional expense. Okay, if you purchase any tools for work that you're not reimbursed by your employer, those will be also an expense. Okay, and mileage. If you're not reimbursed for your mileage, miles will be deductible. Okay, as long as you're not reimbursed by the employer. Okay, if you work from home, if you pay internet, power, and some utilities, those will be also accounted for as itemized deductions. So those are deductions. Okay, let's take a note here that deductions are different than adjustments and or losses and credits. So these deductions only will help you bring your taxable income lower. Okay, and I'm not covering other deductions. I'm just giving a pretty decent idea, okay, of what deductions to include, such as also clothing, boots, tools. Okay, so those deductions will bring your taxable income lower, and the amount of taxes you'll save will be multiplied by the tax rate that you fall under. Okay, so if you're paying federal tax of let's say 12%, okay, and you had an expense of 5,000 in qualified deductions, let's just say, okay, so now you're saving 600, okay, 5,000 times 12%, that will be 600. So that will be the tax savings that you're particularly aiming for this particular in my particular case. Okay, so this is another version, another video. So hopefully you'll find this video helpful. And please, if you found this video beneficial, please give it a like and subscribe. Thank you very much.